we are coming to look at how to account for maybe a government loan. You see that whenever a government is giving a loan, the government usually give the loan at a subsidized interest, which will be different from the normal interest if it should be taking the loan from a third party. So if that happen, how do we account for that? How do we account for that? So whenever an asset or a loan is being given out at a subsidized amount or at an interest rate which is lower than the current market value, what we do is that the instrument must initially be measured at fair value. So sometimes the mostly the government loan, this always happens to the government loan. So the government loan will be given at a subsidized interest. The government loan will be given at a subsidized interest. How should the entity initially account for that? Okay, the financial instrument will initially be accounted for, will initially be at a fair value. How do we determine the fair value? The fair value is determined as the present value of all the cash flows. The present value of all the cash flows. And the present value that we are going to calculate, we are going to use the actual interest rate. So we are going to use the actual interest rate. If you should get this amount or this loan from a third party, what will be the interest rate? So we use the actual interest rate.
It's just you.
The discount factor, we use the current or the market interest. So mostly if you go to our government, if the government wants to give a loan to a company, what they do is that they will give a loan at a subsidized interest rate. They will give the loan at a subsidized interest rate. The meaning is that if you should go to a bank on a normal transaction terms, if you go to a bank on a normal transaction terms, the loan should have been given to you at an interest rate higher than what the government is giving to you. So if that happens, how do we initially measure that particular instrument? Sometimes they can also call it charity bonds, where the company wants to give the loan to a charity. Since you are giving a loan to the charity, it's like you are helping them. It's a help that you are giving to them. So the interest rate that you are going to charge them will be lower than the actual interest rate that you should have charged if you are giving it to a normal person on a commercial terms. So how do we account for that? The financial instrument will not initially be measured at cost. We measure it at a fair value. How do we determine the fair value? The fair value is the present value of all the cash flows that you'll be receiving. So the cash flows, that all the cash flows will be the interest that the company will be receiving every year, and also the nominal amount, which will be the normal amount or the nominal value that they are going to receive at the end, which will be at the redemption date. So the question can say that the loan was given to a charity. If you are giving a loan to charity, it's just like you are helping them. So the loan will not be given to them on normal commercial terms, like if you are giving a loan to a company. So the question can also say the company has purchased a loan or a debentures of a charity. The question will give you an interest rate which will be lower than the normal interest rate. So if that happens, how do we account for that? The instrument should initially be measured at fair value. How do we determine the fair value? It is the present value of all the cash flows. It is the present value of all the cash flows that a company will be getting from the entity or from that particular transaction. So that we'll pick a question so that we solve that question. Then you look at what I'm talking about. Then you look at what I'm talking about. So let me pick a question over here. Let's pick question 14. Question 14, tutorial question 14. Tutorial question 14. Can someone see that?
So a question before we proceed to the question 14.
Okay.
Yeah. Recently the bank issues.
Yeah.
Where Kent was going to establish some kind of development or stabilization fund for the bank, so that donor fund then we can put some money there to be given to the banks, which I doubt they would do. But in reality, let's look at it in a practical way. Let's assume that this thing happens. Will you consider it to be a grant to the banks?
Who is giving it to them?
This is a fund that Ken said he's going to establish, which they call the development.
Is it a government?
The government. It's a government who said they are setting up that fund.
So is it going to be a support? Is it going to be a support to the banks at no interest rates? Is it going to be a form of a support, assistance to
It's going to be a...
Yes, it's going to be what? Oh, Narazak. Oh, he's gone. Does someone knows about that? Does someone know about that? Maybe I'm not in Ghana.
Hello.
Yeah, Narazak.
Hey, my this thing went off. My network was.
Okay, so you are saying that.
What I was saying.
Yeah.
Ken said he was going to establish a fund, or I don't know whether he claimed he has even done it.
So
and this fund, donor fund, then people.
Is it going to be a support with no interest?
Yes. So let's assume that it is a support with no interest. How do you classify this particular one?
If it would be a support with no interest, then that should be like the government is giving the loan to interest-free loan to the people. Or if the people are going to pay back, then that will be a loan. But if the people are not going to pay back, then that will be a grant.
Okay.
So if the people are going to pay back, then it will be an interest-free loan. But if the people are not going to pay back, then that will be a government grant to the banks.
Okay. All right. Thank you.
All right. Okay. All right. Okay. Let's take the question 14. Auntie Eunice, are you here? Okay, Auntie Gina, read for us.
Okay. Question 14. Charitable Limited is a listed manufacturing company. Charitable granted a loan of 25 million to a homeless charity for the building of a community center. The loan was granted on 3rd January 2018 and is repayable on maturity in 4 years' time. Interest, which is subsidized, to be charged 1 year in arrears at 4%, but Charitable assesses that a normal rate for such a loan would have been 8%. Charitable recorded a financial asset at 25 million and reduced this by the interest received each year. In accordance with IFRS 9 financial instruments, recommend with justification the required accounting treatment for the issue of the loan to the homeless charity in the financial statement of Charitable for the year ended 31st December 2018.
All right. So those asking, I've shared the question again. I've shared the documents, financial instruments. Okay. Let's look at this, please. How much is the loan that they are given?
25 million.
Okay. And they are giving this to them at a subsidized interest rate of what?
4%.
Okay. But in actual sense, if they should be giving the loan to what? If the loan should be given on commercial term, what should have been the interest rate?
8%.
8%.
So what we do is that we assume that they are giving the loan at an amount lower than what the amount that they are giving. So we measure the loan or the asset. This is an asset. I hope you all agree that this is an asset for the company. This is an asset. Okay, we are doing this for the company, not the charity. If we are doing this for the charity, that will be a liability to the charity. But we are doing this for the company, so this will be an asset for them. So the question is, how many years? How many years will the loan be with the charity?
For 4 years.
That will be with them for 4 years.
Mm.
Okay. So it means that at the end of every year, they will be receiving an interest of what? What will be their interest that they will be receiving every year?
4% on 25.
Okay, they will be receiving 4%. That is the interest that they will be receiving 4% every year for 4 years. And at the end of the 4 year, what will happen? The loan is repayable on maturity in 4 years' time. So at the end of the 4 year, how much are they going to pay them? At the end of the 4 year, how much will the company receive from the charity?
The loan plus the interest.
No, they will receive the interest every year. So at the end of the year, they will receive the principal. So we
Principal.
assume that they will be receiving the interest at the end of every year.
Thank you.
So at the end of the year, they will receive their interest. But in addition to the interest, they are going to receive what? The principal amount. The charity will pay back the loan to them, which is the 25 million. So what we do now is that these are future cash flows. At the end of every year, we are going to be receiving 4% on 25 million. So how much will be that every year? And at the end of the 4th year, we are going to receive what? 25 million. What is the today's value of those cash flows? That's why we are talking about the present value. So what we do is that we are going to use the present value table, which we have the years, we have the cash flow, we have the discount factor, which is the 8%. Then we have the present values. Okay, don't put year zero here because we don't have, this is not investment or this, we are not trying to appraise any project here, no. So we don't have year zero here. All right, so this is, we are just looking for the cash flow. So what we do is that we can use annuity because the interest will be fixed every year. It will be 4% every year. So the interest will be 4% on 25 million. How much will be that? 4% on 25
1
million
million.
will give
1
us what?
million. 1 million.
1 million.
Yeah.
Okay. So it means that at the end of every year, we'll be receiving what? 1
1
million.
million.
And that is an annuity when you are going to receive a fixed amount at the end of a particular period, or you are receiving a fixed amount at the end of a particular tenor, or every month you are receiving a fixed amount. We call that annuity. So if you are receiving equal amounts at the end of a particular period, that is called annuity. So we can use annuity factor for this, or we can decide to use our discount factor. We can do it one by one, or we can do for the 4 years. So what we'll do is that year 1 to 4, I'll be receiving 1 million. Okay, so what I will do is I will now find annuity factor at 8% for 4 years. Okay, those of you that you are not familiar with financial management, okay, this is how we find annuity. Annuity is calculated as, annuity factor is calculated as 1 minus into bracket 1 plus R exponent negative n divided by R. Okay, where the R is the discount factor and the n is the number of years. So over here we can see that, let me put it here. We can calculate our annuity factor as 1 minus into bracket 1 plus 0.08 exponent negative 4 divided by 0.08. So you can do it and approximate your answer to 3 decimal places. So 1.08 exponent negative 4 all divided by 0.08. What are we getting?
3.312.
3.3
1, 2,
312.
3, 1.
Okay. Let's count 2. So this is the interest that we are receiving. But at the end of the 4th year, what are we going to do? They are going to pay us our principal, 25 million. Am I correct with that?
Yeah.
Okay, and this is a one-time payment. So what will be the discount factor? We use a discount factor for this one, and that will be 1/1 plus R exponent n. This is just one amount that you are going to receive. It is a lump sum that you are going to receive. So what we do is that this will be calculated as 1/1.08 exponent 4. What are we getting? 0.735. 735. Okay. So for us to find our present value, it is a cash flow plus the discount factors. So this will be 3.312, and this will be 25 times 0.735. What are we getting?
18.38.
18.38.
38.
Let's add a 3.
1.7.
Okay. 21.
7.
21.7. Okay. So this is the fair value. So in actual sense, this is the value of the loan that we are given. In our books, this will be the value of the loan. But how much did we give to those people?
25 million.
25.
So what will happen is that we are going to have a financial asset. Our financial asset will be recognized at fair value, 21.70. Then our then we have cash of 25 million. So we are going to be crediting cash, debit financial asset. You can see that we are making a loss, isn't it? So we debit profit or loss of what? What will be the difference?
Three point three.
3 points. Right. So the asset will be recognized at the fair value, which is 21.70. Then what will happen is that we are going to have cash. This one, we are giving this to them like this. But it doesn't mean that we are going to give them 21.7. We are going to give them the 25 million. But if this should have been given to a third party, the actual amount should have been 25. But since we are giving it at a subsidized amount, the actual financial asset that we are giving to them or we can recognize is up to the fair value, which is 21.70. The difference over here will be a loss. The difference over there will be a loss. So how this is initial measurement, how would this be subsequently measured? How would this be subsequently measured? Let's come to the subsequent measurements. The subsequent measurements will be through amortized cost because the question didn't say the company will be taking the money at any time. So it will be repayable at the end of what? The 4th year or at the maturity date. This is financial asset through a debt what? Instrument. So the classification is 3: profit or loss, other comprehensive income, and amortized cost. Profit or loss is for speculative purposes where the company is having the investment that they can sell it at any time. So that is profit or loss. Other comprehensive income is that they are thinking about keeping it up to maturity, but they are also looking for better opportunity to sell it at any time that there is a market for it. But amortized cost is the company is committed to hold them, the investment up to maturity. And if you can look at this question, that is what we have here. So what we do is we do our years, our amortized table. We have the balance down. We have our interest. We have our coupon. Then we have our balance carried down. So the years, the question is asking us to do only 1 year. So we have year 1, then we have 21.70. Our interest will be 8%. So let's apply 8% on that.
$1.74.
74.
1.74. Okay. Then our coupon will still be the normal interest that we'll be receiving at the normal rate. That will be our coupon. So what will be our balance at the end now? 21.70 plus 1.74 minus 1. What are we getting?
$22.44.
22.44. So that is it. In the profit and loss, the company will show a finance income of 1.74, which is profit or loss. In the statement of financial position, they will show financial assets as a non-current asset at 22.44. So the question is if you do it for only 1 year. So that is all. All right. So that is all about charity. Mostly they call it a charity bond or maybe a government bond. The government can also give it to the company. The company has to measure the instrument at a fair value. The fair value is the present value of all the cash flows that the company will be receiving or will be paying to the government, which will be discounted as the what? The current market rate. The current market rate. So that is all about that particular question. I want to move on to compound instruments. Compound instruments. Compound instruments. You see, compound instruments, if you talk about compound instruments, we are talking about an instrument which is having a characteristics of debt and also a characteristics of equity. So part of it is equity and part of it is what is debt, which mostly we call it a convertible instrument. Convertible instrument. So the convertible instrument, the company will have options to convert to equity at the redemption date, or they should receive the amount that, or they should receive the nominal or the redemption value of the company. So whenever they say a convertible instrument, part of it will be for equity and part of it will be for debt. So let's look at what we call a hybrid instrument or a compound instrument. This particular instrument has the characteristics of debt and also the characteristics of what? Equity combined. So whenever these instruments are issued, we have to separate them. So we have to know the debt component and also the equity component. We have to know the debt component and also the equity component. So we look at how we determine the debt component and how we determine the equity component. So how we determine the debt component and how we determine the equity component too. All right. What we do is that the debt component is always the cash option. The debt component is always the cash option. The cash option. And this is always the balance figure. The balancing figure, which is what is the actual amount and what is the cash that we are paying. The cash option will always be the present value of all the future cash flows. Okay. The debt, if it is a debt, what you do is that you pay interest at the end of every year. So the interest is cash. It's an amount that you are going to pay. So it's part of the cash. But this amount will be paid in the future. So what is the today's value of those items? Or this is also like finding the market value of a debt instrument. If you want to find the market value of a debt instrument, what we do is that whatever money that we are going to receive in the future must be the same as the money that we are giving to the company today. That is the assumption. So whatever money that you are going to receive in the future is based on the money that you are giving to the company today. So the assumption is that if you find today's value of all the money that you are going to receive, it must be the same as the money that you are giving today. That is how we find the value, the market value of a debt. We present value all the cash flows relating to the debt to find the market value. Okay, so you have to present value or you have to discount all the cash flows relating to the debt component. Then you compare with the total amount from the instrument. Any difference between the two will give you the equity component. So what we do is that the debt component is calculated as a cash option. How do we calculate that? It is the present value of all the cash flows. The cash flows include the annual interest, which is the coupon. The annual interest that a company will be receiving, which is a coupon, and also the redemption value. So the loan will be paid back. So the present value of all these two. The present value of all these two. Which discount factor do we use? We use a discount factor. We use a rate of what? A similar instrument without what? Conversion. We use the rate of a similar instrument without what? A conversion. So we are not, the assumption is that we assume that we are not converting this at the end of the year. So if we are not converting this, what is the interest rate? What is the market rate of a similar instrument which cannot be converted? So we use the rate of a similar instrument which will not be converted. But the major option, the major problem is the discount. It's the same as this one. How we calculate this is the same as the debt component here. It's the same as the debt component here. So let's pick at least maybe 2 questions. Okay, 637. After the hybrid instruments, it is likely that it will be the hybrid instrument that will come in the exams for you. In corporate reporting, financial instrument will come, and financial reporting, you see financial instrument there. Okay, so you have to pay attention. Even those doing final account and those doing consolidated financial statements, corporate reporting and financial reporting, you can still see this as a footnote. Okay, so let's pay attention to that. Okay, let's take a question which is involving a convertible instruments. Okay, let's take the question 6. Let's take the question 6.
A company issues 100,000 5% convertible bonds with a nominal value of 100 Ghana cedis each on 1st January 2014. Each bond is convertible at any time up to maturity into 120 ordinary shares for every 100,000 bond. 100 Ghana cedis bond. Alternatively, the bonds will be redeemed at par after 5 years. The market rate of interest for a similar 5-year bond, 5-year term bond with no conversion option is 7%. Required. Calculate the liability and equity components of the above instrument. B. Calculate the carrying value of the liability components that would be shown in the statement of financial position at 31st December 2014. Give your answer into the interest to the nearest Ghana cedi.
Okay, that is nice. We are going to solve that, and I'll pick another one where we will do it and assume that the company is going to do a conversion. They are going to convert it. Okay, and I will show you how we go about the conversion, how we go about that. Okay, let me see a question so that before we can solve that. Okay, can I find any question? Okay, so what I will do is that I will assume that the company is going to convert this. I will assume that first, okay, before we still pick another question. Then we count to factoring. We call something factoring. Okay, factoring, you are going to sell your debtors to a factor and get money. How do we go about that? Those who are doing financial management, you have learned that already, but just that you didn't learn the accounting side of it. Okay, let's count to the financial assets. We are looking at question what? Question
Question
6.
6.
Okay. What I want to say is that you see, the question can also give you a transaction cost. The question can also give you a transaction cost. The question can also give you a transaction cost, or the question can also say that the instrument has been issued at a discount. Okay, you see that the instrument is going to consist of both equity and what? And debt. So if you are given a transaction cost, find your, okay, I will not talk about that now. Let's look at the question 6. Let's look at how we solve the question 6. Okay, so what is the total value of the convertible bond? The question will say that convertible bond. If it is a convertible bond or convertible instrument, just know that part of it is for equity, part of it is for debt. How do we separate the two? That is what we are coming to do. So what is the total value of the bond? What is the total value of the bond?
100,000.
100,000.
Okay, are you sure? The 100,000 over there is the
100,000
number
times
is the number of
100
yes.
times this.
So it will be 100,000 times 100. That will be 10 million. Would that be 10 million?
Yes, 10 million.
Okay. So the 100 over there is the number of what? Units that they are issuing. Is the number of units. So if you want to get it is the unit multiplied by this one. So that will give us 10 million. Okay. All right. What is the nominal rate? What is the actual interest that we should have been receiving every year on the instruments? So our coupon,
5%.
so 0.05 times 10 million. How much are we getting every year?
That'll be 500,000.
Okay, that will be 500,000. Okay, so it means that at the end of every year, we'll be receiving 500,000. And at the end of the contract life, which is when are they going to redeem it? After 5 years, isn't it? So we are going to receive the 500,000 for 5 years, and this will be redeemed at par after the 5 years. So we are going to receive 500,000 every year, and at the end of the 5 years, the company will now pay us back our money, which is the 10 million. The issue is we are not converting to equity shares. So just do your calculation without taking into consideration conversion. You are not converting anything. So we are just taking our money back. We are taking our money back. We are taking our money back. Okay, so we are not doing any conversion because the interest rate that we are going to do will deal with that or what? A conversion. So we are not converting it. Okay. Okay, so let's move on. How do we do this? Let's find the debt component. This is how we find the debt component. So you have to separate the two. How do you find the debt component? The debt component is the same as what we did first. The years, the cash flow, the discount factor. The discount factor, we use the rate of what? An instrument that is without what? A conversion. So the market rate of interest for a similar 5-year term bond with no conversion option is what?
7%.
So we use the 7% as a discount factor. So we now have our present value. So it means that year 1 to year 5, what will be the cash flow that we are going to receive? year 1 to year 5, we are going to receive the interest.
500,000.
Okay, so that will be 500,000. So you can see that this is an annuity. So we find the annuity factor. What will be the annuity factor for this? It will be 1 minus into bracket 1 plus R as for negative n divided by R. If you like, you can do it one by one. Someone can do it year 1, 500,000, year 2, 500,000, and the person will find the discount factor one by one and put it there. But you have to know that you are using time. You have to know that you are using time. So you have to know how to manage your time. You have to know how to manage your time. And if you are writing corporate reporting, the assumption is that you have done all these things in level 2. Financial management, you have done this. Management accounting, you have done this. So you are okay with the annuity factor. Okay, let's move on. What will be the annuity factor? 7% for 5 years. So 1 minus into bracket 1.07 as for negative 5 divided by 0.07. What are we getting?
4.2. Yeah.
5.389.
Someone is saying 5. Can we confirm that?
Yeah, I had 4.100. It's 7%, right?
Yes, 7%.
Yeah, it's 4.
4 points.
1
One word.
0 0 0 0.
Okay. You see, you go and you see me on the way and say, "Oh, sir, I've killed the newspaper." Meanwhile, you haven't done anything. You see, Robert, you see me and say, you have killed the paper. That paper, you have killed it. Meanwhile, the annuity factor, your annuity factor is wrong and everything is wrong. Since the annuity factor is wrong, it means that the figures will also be wrong. So at the end of the 5 year, what are we going to do? We redeem what? Alternatively, the bonds will be redeemed at par after 5 years. So after the 5 years, they will redeem the what? The instrument. They'll redeem the instrument. So if they are going to redeem it, it means that they are going to buy it back. Buy it back at what? At par. The par is the what? The nominal value, which is the 10 million. So in year 5, we are going to receive our money back, which is this. And this is only one-time payment. So what we do is that we find only discount factor for 5 years. So 1 divided by 1 plus 0.07 or exponent 5. What are we getting?
0.713.
0.713. So let's now find our present value. 500,000 times 4.10. What are we getting?
2050,000.
2050,000. Okay. Year 5. What will be the present value?
One, 0,000.
Okay. So the total give us what?
9180,000.
9180,000. Okay. So this is the present value of all the amounts. But what is the today's value of the bond? What is the today's value of the bond? Today's value of the bond is a 10 million.
10 million.
Okay. So it means that after the present value, after presenting the cash flow, it should give us the what? The 10 million, but it is not giving us the 10 million. What is the difference? What is the difference?
820,000.
820,000. Okay, so this is the equity component. So the debt component is always the present value of all the cash flows. Okay, and the difference between them, the difference is the nominal value today and the present value. The difference between them is the equity component. Okay. The question is, I was saying something. You see, they can say the thing was issued at a discount. The question can say that this was issued at a discount. Before you start this, the discounts must be net against this. So you subtract the discount from the 100,000 before you will come and subtract over here. But if it is a transaction cost, this is what we do. If it's a transaction cost will be for equity and also the same time for the what? For the debt. So don't do anything to the transaction cost. After you have calculated these figures, then you now share your transaction cost in their proportion. So debt is 9,180,000. Equity is what? 820,000. So assuming the transaction cost is 20,000, the transaction cost will be shared like this: 9/8 over 1,000 times 20,000, and we are going to have 82 over 1,000 times 20,000. I'm just using their figures, but I'm taking the zeros out. So this is how we are going to share the transaction cost before we account for it. The accounting for the transaction cost is the same. If it is debt, we subtract. If it is financial asset, we add. So that is how we are going to do it. So the transaction cost, find your debt and equity component before you use their proportion to share the transaction cost. But if it is discount, the discount will be subtracted from the nominal value before we calculate our debt, because the discount will be given on the nominal value. So you net the discount against this amount before you calculate your equity component. But transaction cost, you share it. You share the transaction cost among them based on their what? On the proportion over here. Okay, Gina.
So I want to understand I want to understand this. So I think that if it was to be a discount, the cash flow would have been less
No. The cash
before
flow
we get the
the
present.
cash flow will still be calculated like the way we have calculated it like this.
Okay.
Okay, this will still be 500,000. This will still be what? 10 million. But the value over here, the total value that we are going to use over here will not be 10 million. It will be net the discount.
Oh, noted, sir.
Okay, all right.
Thank you.
Okay, so if there's a transaction cost, this is how we do it. If there's a transaction cost, this is how we do it. But in this question, there's no transaction cost. So what we do is that if we have to subsequently measure our equity, not equity, we have to subsequently measure our debt. You can see that the debt component, the instrument will be there for 5 years. So that is what? Not through profit or loss. So that will be through amortized cost. So after separating this, what you do is that you now amortize your debt component. It's just like the normal amortization that we do. So we have the years, we have the balance carried down, we have the interest. The interest will be the market rate, which is at 7%. Then we have the coupon. Then we have the balance carried down. So year one, our balance brought down, which is the balance at the beginning, will be 918,000. 9,180,000. The interest will be what? 7%. And the coupon will still be 500,000 every year. So what will be the interest on that?
642,600.
642.
600.
Okay. 642,600. So our closing balance, the coupon will still be the interest that you're receiving at the end of every year. So the coupon doesn't change. The coupon doesn't change. Okay. This will be the interest that we're receiving every year. So our balance carried down now will be this plus this minus this. That will be the balance carried down for the first year. So in the first year, this will be the interest, the profit or loss, finance cost, and the closing balance that you get over here will go to balance sheet as a non-current liability. So the subsequent measurement is the same as the subsequent measurement for a liability at an amortized cost. But the equity, we don't remeasure equity. Equity once measured will not be remeasured. That's why we don't remeasure our equity. If you see stated capital, the stated capital will be the same unless there is additional issue of shares. If there's no additional issue of shares, every year the stated capital will be the same amount. We don't remeasure equity. We don't remeasure equity. So the equity component will be sent to other components of equity. This will be sent to other components of equity. It will not be added to the normal equity. It will be treated as other component of equity. But the debt component will subsequently be measured at amortized cost like this. At amortized cost like this. So you do it. You want the figure that you get over here. You count to year 2, you charge your interest, you put your coupon here, you put the difference there, that will become year 3. Okay, it's the same as what we did yesterday. But what I want to talk about now is what if the question should say that the people has now decided to convert the debt to what? To equity. Whether they are going to convert it or not, the calculation, the separation will still be the same thing. This calculation will still be the same. You first have to do it as if they are not going to convert it. And the conversion will be done at the end of the year. So you do it that the conversion will not be done from the start to the end. It is at the end that they are going to do the conversion. So the calculation will still be the same like this, but at the date that they want to convert it. Let's assume that at the end of the 5 years, the value on the amortized table, the amortized table, the value at the end of the 5 years, this is the closing balance over here. This is the amount that they are going to pay. Assume that at the end of that one, the value is what? 10 million. Let's look at this. Let's look at this. The question is saying that each bond is convertible at any time up to maturity into 120 shares for every what? 100 Ghana cedis bond. So let's look at the number of shares that they'll be having. The total value of the bond, is 10 million. Okay. They are saying that every 100 of this is equal to 120. Every 100 of the 10 million is equal to 120. Every 100 of the 10 million is equal to 120. So the total value will be equal to 10 million. And they are saying that every 100 of this is equal to 120. So how many hundreds can we see here? This will be divided by 100. Would that be 100,000? Then we now multiply by 120. Are we okay? So they say
Yeah.
every 100 of that. So you divide this by 100, or you divide this by the portion that you are converting, then you multiply it by the what? The shares that they will be having. So let's multiply this out and see. We will be having 12 million shares. Would that be correct?
Yes.
Okay, assuming the value of one share is 1 Ghana cedis, it means that this will be 120 million. 120 million. I say 120 million. 12 million. Okay, this will be 12 million Ghana cedis. Okay, so the shares that we are going to have at the end of the year is 120 million. Okay, and if we want to receive cash, it will be 10 million. But if we are changing the thing to equity, they are going to give us 12 million shares. But if you are receiving cash, it's 10 million. The holders will be willing to convert if they see that the value that the shares is giving to them is higher than the value that they'll be receiving cash. That is the only time that they can convert. But the question is, if the question is not telling you that the people have not accepted to convert the shares, what will be the entry now? Okay, you will see that at the end of the 5 years, this will still be classified as a liability, isn't it? This will still be a liability. Are you okay?
Yes.
Okay.
Yes.
But now they are saying that the liability will be transferred to what? To equity. Under normal circumstance, the shares that we should be giving to these people should be 10 million. Am I correct with that?
Yes.
The shares that we should give to them should be 10 million. Okay. But what are we giving to them now?
12 million.
We are giving them what?
12 million.
12 million. We are giving them 12 million. What does that mean? It means that liability will be what? 10 million. Liability will be 10 million. But our shares now will be what? Our shares that we are giving to them is what? 120 million. The actual amount that we should have received should have been what? 10 million. But the amount that we are receiving now is what? 120 million. What is the meaning of that?
There has been a gain.
We don't call it a gain. There's a name for it.
Premium.
Yes, we assume that the shares are being issued at a premium. So what we do is that we will debit a liability of 100,000. We debit equity of 100,000. We credit equity of 100,000. Okay, so we debit a liability of 100,000 to cancel this liability on the account. Then we also credit what? Equity. The amount that we are going to transfer to the equity will be the value of what? The liability. That will be the amount that will go to equity. Any excess will be sent to either premium or any difference, which is the liability being higher than the equity. We assume that this thing has been issued at a discount. So any difference over there will be, no, this will not be, okay, this will rather be at a discount. Okay, this will rather be a discount, not premium. Sorry. This will rather be what? A discount, not premium. Sorry. So we assume that the shares are being issued at a discount because we should have received 12 million, but we are receiving what? 10 million. So the shares are issued at a discount, not premium. Sorry for that. Not premium. Sorry for that. Okay. But a situation where we are giving a lower shares for higher liability, that is why we assume that the shares are being issued at a premium. So if you are giving a higher shares for lower liability, it means that the shares are being issued at a discount. That is why the cash that you are receiving or the money that you are receiving is reducing. So the shares are issued at a discount, not premium. Sorry for that. So the entry will be you debit your liability to remove that, which will be you debit your liability to remove the 100,000. Okay, you debit your liability to remove the 100,000. Then you debit your liability to remove your 100,000. Then you now debit your profit or loss, which is a discount of 20,000, 200,000 rather. Then you count your equity. You credit your equity with 120,000, 12 million rather. So this will be 2 million. So this is how we do it. But the question will always not tell you they are converting it or not. They will not tell you that. But this is something that I'm telling you if there should be the case. If your liability is lower than the shares, it means that the shares are being issued at a discount. But if the liability should be 12 million, and your shares that you are giving to them is 10 million, it means that you are issuing a shares of 10 million for 12 million. So the shares are being issued at the premium of 2 million. So that is it. So if you are receiving a higher portion for something that is less, it means that you are issuing it at a premium. So if you issue shares for 10,000, you are receiving a 15,000. The 5,000 over there is a premium. So the shares that we are giving is 10 million, but the liability that we are receiving is 12 million. We are receiving more than we are giving. So that is a premium of 2 million. But if we are giving more than we are receiving, that is a discount. Okay, take note of that. So that is how you go about it. This is how you go about it. If they see the show entry, if the company decided to what, to convert the convertible instrument. Let's pick one question in addition so that understanding will be clear. Let's look at the question 5. Let's look at question 5.
Question 5. An entity issues 2% convertible bonds at their nominal value of 36,000 on 1st January 2015. The bonds are convertible at any time up to the maturity into 120 ordinary shares for each 100 Ghana cedis of bond. Alternatively, the bonds will be redeemed at par after 3 years. Similar non-convertible bonds would carry an interest rate at 9%. The entity is preparing its financial statement for the year ended 31st December 2015. They are not sure how to record the convertible bonds and therefore have credited the 36,000 cash received to non-current liabilities and have recognized the interest paid in the year as a finance cost, required. Prepare a journal entry that should have been applied to correctly record the initial recognition of the convertible bonds. Prepare extras for the statement of profit and loss and statement of financial position for the year ended 31st December 2015. What are the journal entries required to correct the entity's accounting records in the year ended 31st December 2015?
Okay. So you can see that they are saying that they don't know how to account for this. So what did they do? They have recognized all the 36,000 as what? As a liability, isn't it? Is that what they have done? Is that what the entity has done?
Yeah.
Okay. But in actual sense, we should have separated debt and what? Equity. So what you are coming to do is that you have to do the separation. So prepare the journal entry that should have been applied to correctly record the initial recognition of the convertible bonds on 1st January 2015. So you have to do the separation first. So let's look at the separation. Separation, we put the debt component. So let's find the debt component. You always find a debt component. The difference between the debt and then the total amount will give you the equity. So let's have the years here. Let's have the cash flow. Let's have the discount factor. And let's have the present value. What will be the discount factor we are going to use? What is the discount factor we are going to use?
2%.
A.
The
9%.
9%.
Sorry, 9%.
Okay. Okay. So how many years? How many years are they going to be having these particular investments?
3 years.
No, with 3
3
years. So that 3 years we are going to receive interest annually for 3 years. So what will be the interest? What will be the coupon? What is the interest that they will be receiving on this particular investment? What will be the annually interest? I'm getting 720.
Yes, 720.
Okay. The interest will always be the what? The coupon. The coupon will always be the interest. So let's find the annuity for 3 years, 9%. And in the third year, it will be redeemed at par. So it is always at par. But the question can give you a different value. If they give you a different value, you use that one. But mostly it will be at par. It will be at par. It will be the same as the nominal value. So let's do the annuity factor for 3 years, 9%, and the discount factor in the third year.
2 points. Annuity
2.531.
531.
Okay. The discount factor for 3 in the third year,
0.77.
0.77. That's all.
0.772.
Okay. So let's find the present value now. 720 times 2.531. What are we getting?
1822.
Is what?
1822.32.
1822 point what? 32. Okay. What
The
about
second one is 27792.
27792? That's all.
Yeah.
Okay. So let's make this one also 00. So let's just make it 1822. Let's add the 2.
29614.
29614.
614.
So the equity component will be what? What will be the equity component?
That should be 6386.
63.
86.
Okay. Okay. So they are saying that we should pass the journal entry where the journal entry that should have been applied to correctly record the initial recognition of the convertible what? Bond. So the actual thing should have been what? You debit cash of 36,000, then you credit liability of 29614, then you credit other component of equity 6386. Okay, so you can see that correctly they have debited the cash because they didn't see anything about them doing something about the cash, which is wrong. They say that they are not sure of this and they have credited the cash received of what 36,000 to non-current what liability. So it means that it's only liability that they have credited with what 36,000, which is the wrong one. The actual figure that should go there would have been what 29,614. But in the liability account, it is now 36,000. The two entries that they have passed was debit cash 36,000 and credit liability 36,000. But in actual sense, this 36,000 should have been what shared or should have been treated among liability and what equity, other components of equity. So what we are going to do now is that we are only going to adjust the amount in the liability. So liability is going to be having a credit balance of 36,000. So what do? We do
With
debit
debit.
liability with what amount? 6386
3386.
to reduce it to the 29. This one. Then you now credit what? Other component of what? Equity. 6386. So this should have been the correct what? Entry. So the correct entry should have been debit cash, 36,000, credit liability, and credit other component of equity. And what we have done right now is the C. What I have done right now is the C. You can see that the C, they are saying that you should pass an entry to correct what? The entity accounting records in this one. So this is for the C. This is one part of the C. Okay. After we have done with the B, we look at the another entry for the correction of what the finance cost there. Okay, the interest that they have interest paid in the year as a finance cost. The interest that they are talking about is the coupon. So the coupon that they pay, they have charged the coupon to profit or loss, which should not be the actual interest. Okay, so they say prepare extracts from the statement of profit or loss and order and statement of financial position for the year ended 31 December 2015. So this is just a 1 year thing. So this is just a 1 year thing. So subsequently, the liability will be measured at what amortized cost. So what we do is we take our fair value of the liability, which is 2929614. Then we charge our finance cost on it. We charge our finance cost on it, which is a 7%. We use the 9% rather, which is 9%. We use the market rate that we use to present value it. So 9% on 29614. What are we getting?
2665.26.
266.
5.26.
2665. Okay, let's look at 2665. What will be the coupon?
720.
Okay, coupon with 2%. So we are going to pay the coupon of 720. What are you getting?
$31,559.
31,559.
9.
Okay, so in the statement of profit or loss, we should have a finance cost of what? We should have a finance cost of 2665. But the only amount that they entered over there was the interest rate, which is a coupon. So the amount that we have to enter now is 265.1720, because they have already entered what? 720. They have already entered the 720. They have already entered the 720. Okay. Or okay, the question says that they have charged this to profit or loss, which is the interest paid. The interest paid is the actual interest that we are paying, or the nominal interest that we are paying. The people are giving this thing to us and we are guaranteeing them 2%. So at the end of every year, we pay 2% on the amount, and that is the interest paid. But if we are calculating it, because some part of it is for equity, we have to factor the equity component so that we use effective interest rate, which is the 9%. So 2665 minus 720, what are we going to get?
1945.
1945. So this will be the amount that we add to the finance cost because they already have 720 there. Let's count to statement of financial position. Okay, the statement of financial position, we have a non-current liability, and this will be a financial liability. Okay. In actual sense, the amount that we should recognize as a non-current liability should be 31559, but we have 36,000. It's the 36,000 that they have now. So what figure should we subtract from this so that we can get our 31559? This is the actual figure, which is the balance carried down here. That will be the figure that will be shown there. Okay. So what do we subtract from this? So 36,000, which is the liability that they have, minus the 31559. Then that will be the subtraction that you do over here. Okay.
4441.
Okay. 4441. Okay. So this is the figure that we are going to recognize as a liability, which is a closing balance. All right. So the last part, we should pass an entry to we should pass an entry to correct this. So we have done the first one, which is this. We have done the first one, which is this. So if we have done the first one, it means that we have brought the liability to this amount. So the next one is we will now come and debit profit or loss with 1945. What do? We credit a liability of 1945 because the liability should have been 31,559. So what you do is add this to this, add the 1945 to this and see whether you are going to get the 31559. What are you getting?
Which added to what?
The liability that we have is this, isn't
That
it? So
yes.
12,614. Then you add this one to it, 1945. Okay, you get 31559, isn't it?
Yeah.
Okay, so that is the entry. Let's come to what we call factoring. After the factoring, so factoring of receivables. After the factoring, then we look at impairment of financial assets. Then we stop there. Okay, if you talk about factoring of receivables, okay, we have a company may need money. You have plenty receivables. A lot of people are owing the company, but they need money to do other activities. So the company have two options to raise finance through the receivables. They can do what we call factoring by selling it or by outsourcing the collection of the receivables. Or they can also pledge it. The pledge means that they will use it as a collateral security to take money, which is what we call the invoice discounting. So the factoring is a situation where the company is trying to sell its receivables to a third party. So someone is owing you and you need money. You can say that, oh, this person is owing me. So what we'll do is that give me this money and go for that money and chase that particular person for the money. The factory, we have two options. I will say that, okay, the person is owing me 10,000. Just give me 9,000 and that is all. I won't come for any money again. It means that whether the person pay or not, you will not go after me for your money. I'm giving you 10,000 as a receivable. Go and collect it. Just give me 9,000. That is fine now. I won't come for any money again. Whether you are able to receive all the money, I won't bother you again. It means that the assumption is that out of 10,000, I'm receiving what? 9,000. And I'm not going to receive the difference of 1,000 again. So this 1,000, what will I do? What will I do to the 1,000? Or the 10,000? Will the company still be having the 10,000 in their books again?
No, please.
Okay. So the company has to de-recognize the receivables. So if they de-recognize the receivables, they are going to credit the receivables of this 10,000 and they are going to receive a cash of 9,000. What will happen to the 1,000 difference?
Bad debt.
Bad
The
debt.
company will write it as a bad debt. So we have factoring without a recourse. Factoring without a recourse. The factoring without a recourse means that the company is selling the receivable entirely. And any amount of money that maybe the bank or the factoring company will be giving to them is a final amount. They won't be receiving any money again, even if the people are willing to, or the people are able to collect all the money. Or even if the people are not able to collect the money, it's none of their business. So we have sold the receivables to you, and that is fine. We don't have any business agreement again. If that happens, then we assume that the company has taken or the company was able to collect some portion of what? Of its receivables. So the company should write off the receivables because they're not going to receive any money again. And they should find the difference between the amount that they receive and the amount that is the receivables. Any difference over there should be recognized as a bad debt. it will be recognized as a bad debt. But the situation is, we also have what we call factoring with a recourse. Factoring with a recourse is a situation where the factoring company will tell you that, okay, we are giving you, although the receivables is 10,000, we are giving you 8,000 now, which is upfront payment. If we are able to collect the money within 3 months, we give you additional 1,500. But if we are not able to collect the money, you give us our money 8,000 and you pay interest of what? 5%. The question is, have you passed all the risks and the control regarding the receivables to the factoring company? The risks associated with the collection of the debt, has it been passed to the factoring company or is still with the company?
It's still with the company.
It's still with the company.
Okay, but you can see that under the first example, the company has now passed everything to the what? To the factory company. Okay, but the question now is, what is the assurance that the factory company will be able to receive the money within the 3 months? You don't know. So what we'll do is that you are just telling those people to receive the money for you, but they should receive the money for you, but they should give you some money now before they will start collecting the money. So the money that they are giving to you will be treated as a loan, because they have not done, you are not selling the receivables to them entirely. After 3 months, they will bring the receivables to you and you pay them interest on the amount that they have given to you. So if it is factory with a recourse, any amount given to the company upfront is treated as a loan, and the receivables will not be derecognized, because the company will bear the risks and everything if the factoring company is not able to receive the money. So any money given to the company should be treated as a loan. If the factor or the factoring company is able to receive the money, then the company will receive that particular amount of money before they recognize whether there to be a bad debt or not. But situation where it is a factory with a recourse, where the company is liable to pay any amount if the factoring company is not able to receive all the money. They will give them a condition that if we are not able to receive the money, this and this, it means that the risks and the control associated with the receivables are not passed to the factory company. Therefore, the company should treat any upfront payment received for the factory company as a loan. So you pay attention to the question very well. You pay attention to the question very well. On that note, let's pick this question. Let's pick tutorial question 22. Question 22.
Ajara Limited has two receivables that it has factored to a factoring agency, the GBB Bank, in return for immediate cash proceeds of less than the face value of the invoices for the year ended 31st December 2020. Both receivables are due from long-standing customers who are expected to pay in full and on time. In addition, Ajara Limited agreed to a 3-month credit period with both customers. The first receivable is for 400,000 Ghana cedis in return for assigning the receivable. Ajara Limited has just received from the factor 360,000 Ghana cedis. Under the terms of the factoring agreement, this is the only money that Ajara Limited will receive, regardless of when or even if the customer settles the debt. That is, the factoring agreement is said to be without recourse. The second receivable is for 200,000 Ghana cedis, and in return for assigning the receivable, Ajara Limited has just received 140,000 Ghana cedis. Under the terms of this factoring agreement, if the customer settles the account on time, then a further 10,000 will be paid by the factoring agency. The GBB Bank to Ajara Limited. But if the customer does not settle the amount in accordance with the agreed terms, then the receivable will be assigned back to Ajara Limited, who would then be obliged to refund to the factor the original 140,000 plus a further 20,000. The factory agreement is said to be without recourse. Advice required. Advise the directors of Ajara Limited on the proper accounting treatment of the monies received under the terms of the two factory agreements in the financial statement for the year ended 31st December 2020, in accordance with IFRS 9 financial instruments.
Okay, so let's look at the first one, the first receivable. How are they going to account for the first receivable?
Well, senior.
Yes, please.
So I think that since Ajara has received 360,000 from the factoring company, there is still an outstanding of 40,000. So the 40,000 would have to be written off as bad debt.
Okay. 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 That is nice. That is nice. So that is the final amount that they're receiving. They're not going to receive any amounts later again. So Ajaras, you assume that in return for the 400,000, they have received or they were able to collect only 360,000 from the debtors. So nobody is owing them again. So they should de-recognize their receivables and recognize a cash of 360, and the difference of the 40,000 should be recognized as what? As a bad debt, which will be sent to profit or loss. So this is a final amount that they are receiving. Whether the people pay or not, they are not going to receive any money again. So nobody is owing them again. They have sold their receivables for 360,000. So the remaining figure, they're not going to receive it again. So that would be a bad debt. So this is a factoring without a recourse. Let's come to the second one. Let's come to the second one. So you can also answer the first question by saying that the risks and the control associated with the collection of the receivables have been passed to to the factoring company. So it means that the factoring company bears the cost and everything associated with the receivables. So the company does not have any right to those receivables again. Therefore, it should recognize them as it should de-recognize them and recognize the difference as a bad debt. Okay, let's move on to the second receivable. The second receivable.
Okay, let me try. I think the second receivables, I think, is in two folds. One is saying that one is giving a condition that Ajara receiving 140,000, and then if they are able to, the customers are able to settle in full, they will pay an additional 10,000. So looking at that session alone, that means that in total, at that point, at that first condition, they are going to give Ajara company 150,000. Then it means that 50,000 will be left hanging at that point. Then the other half of the condition is also saying that if they are not able to settle, Ajara will be obliged to pay the original 140 that has already been given, plus an interest of 20,000. So at this point, I don't know whether we are going to treat two conditions separately.
No, is it the 10,000 that you are going to receive over there depends on the condition?
Yes.
So what if the people are not willing to? What if the people are not they are not able to collect all the money, it means that you will not receive
Yeah,
the
the
10,000.
10,000.
So
Yes.
you are not aware of the 10,000, that whether you are going to receive it or not, but you have received 40,000, 140,000 now.
Mm.
Okay. And you also know there's no assurance to give you that they will not be able to receive that. So based on
Okay.
prudent concept, you should make provision for the what? For the worst. So what will happen
Okay.
is that if the people are not able to receive the money within the 3 months or the time, they will bring back the receivables to you and take their money plus interest. So the assumption
Mm.
is that the money that they have given to you and the interest that you are going to pay is like they have given the money to you as a loan.
Loan.
Where if they are not able to do this, you are going to pay them interest. So you still maintain your receivables of 200,000 in the books, and you treat the 140,000 as a loan.
Okay.
You treat the 140,000 as a loan. And at the end of maybe, if after 2 months, every month you can calculate interest on it because you treat it as a loan. Sometimes the question will give you the interest rate. So since the control and the risks associated with the receivables are not passed to the what, to the factor fully, the company still bears the what, the risks and the control, because if they are not able to collect it, everything will be returned to the company. So you just assume that you just send the receivables to the bank to collect money. You are using the receivables as a collateral security to collect money. In this case, the receivables should not be recognized because it will be brought back to the company. So why should we de-recognize it and bring it back again? Let's just take the money as what? As a loan, because we haven't sold the receivables entirely to what? To the factoring company. We are just telling them that they should give us an amount now so that they can try and see whether they can take the money for us, or we are just telling them that they should collect the money for us. We are just associating them that they should collect the money for us. So the money that they will give to you as an upfront payment should be a loan. Should be a loan. It's just like someone is owing me as oh, Charlie, someone is owing me, but the person don't want to pay. So I want you to collect the money for me. But before you do that, Charlie, give me some points. So that if you're able to collect the money, I'll settle you. It's just like that. So when the receivables are not transferred entirely or are not sold entirely to the factoring company, anything that will come under there will be a loan. Any money that you are going to receive first will be a loan. Will be a loan. All right. Okay. All right. So let's look at impairment of what? Financial assets. Impairment of financial assets. Impairment of financial assets. Okay. You see, uh this debt restructuring that they are doing, you see, they are doing something, haircut or something, where they are reducing the interest rate and those things. Okay, that is automatically telling you that the investment of the people has impaired, because the money that they are going to receive from what is happening right now is going to be it will be lower than what they should have received originally. So you can see that there is a reduction in the value, and that is what we call the impairment. The impairment. So impairments, we say that it's not something that we do annually, but it's something that we do upon what? A condition. If the condition arises, then we test for impairment. So you have an investment in a bank and they are saying that they are doing a restructuring, or the government is doing what we call the haircuts. It means that they are going to receive, or they are going to reduce the amount of money that you're supposed to receive. The interest that you'll be receiving will be reducing. It means that the investment has impaired. What is causing the investment? It is the policy of the government that is making your interest rate to reduce, or that is making your investment value to reduce. So if you look at those banks that collapsed, if you see they want to pay people, they will not pay you up to the full amount that you have. So that collapsing, you can also see, is an indicator of impairment. Your asset has impaired. So the government policy, which is a haircut, is going to reduce the investment that people are having. The value that you'll be having might, after the agreement, the interest rate will now be low. and the money that you are going to be having over there will now be restructured. So if you are having 10,000, they are now saying that it's 7,500. The investment has lost the value of 2,500. That is an impairment. What is causing the impairment? It is the policy of the government. So sometimes a company might have investment in another company, and that particular company might be facing a financial difficulties. Might be facing a financial difficulties. So they will sit down with the company and say that they want to restructure the 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 investment. They want to restructure the investment, and they will say that okay, based on the challenges that we are facing, the financial difficulties that we are facing, we can no longer pay you any interest. We can only pay you 50% of the amount at the end of 3 years or 4 years. In that case, it means that you will not be receiving interest again, and that interest is a loss now to you. So based on this factor, we can test for what impairment on the financial assets. So how do we calculate this impairment? The impairment, people call it a loss allowance. A loss allowance. So the question will tell you that the company is facing a financial challenges, but these particular challenges are not significant, or the risks associated with the company or whatever is happening to the company is not significant. Although it is not significant, but in some way it is going to affect your investment. So the loss allowances we have what we call 12 months expected, 12 months, 12 months. We have what we call 12 months expected losses. Okay. We use 12 months when the risk is not significant. Okay. But we use lifetime. We use a lifetime. This is not for financial reporting people. Okay. This is for corporate reporting. Okay. Since you are doing financial reporting, you will still do the corporate reporting. So maybe you can decide to pay attention. Okay. So if the risk is not significant, we use 12-month expected losses. So we just make an estimate for 12 months. What will be the losses that will happen within 12 months? So we calculate that losses, or sometimes it can be based on what probabilities or expected values. We do that. Then we calculate the 12-month losses and make provision for it. So if the instrument is 100,000, and we are expecting that within the 5 years, within the next 12 months, the losses will be what? Will be 5,000. What we do is that we still keep the liability, the asset at its nominal value, and we make a provision for the 12-month losses as a provision in the statement of financial position. But this will be treated as profit or loss, but we don't subtract this from this. We are going to keep this as a provision for the first time, which is 12-month expected losses. But if subsequently there was an impairment again, and the impairment is the losses has now increased to 8,000, then what we do is that we have already captured 5,000, we capture 3,000. But the second time, we now come and net the 8,000 against this. So we now have 92,000. So the first time, if for the first time that you are doing the provision, we use 12 months expected losses if the risk is not significant. So if the risk is not significant, we make provision for 12 months expected losses. These particular losses will be treated as a profit or loss, and also be treated as a contra liability in the statement of financial position. It will be treated as a normal provision in the statement of profit or loss as a liability, because the assets will still be carried at 100,000. For the first time, if it is 12 months expected losses, our interest income or our coupon will still be calculated on the nominal value. But if subsequently the provision has increased, the risk has increased significantly, assuming this one. So what we do now is that we will still charge 3,000 to profit or loss, because we have already charged 5,000. for the first year. But what will happen now is that we now have the carrying value. The investment will now be carried at carrying value of 92,000, and the interest will now be charged on the what? On the carrying value. So if the risk has increased significantly, the interest is calculated on the carrying value. But if the allowance is for only 12 months, the interest is still calculated as the original nominal value. That is basically what you are going to see. And corporate reporting people are likely to see this as a question on its own, as a standard on its own, or as part of a footnote, as part of a footnote. So let's solve, let's look at question 23 there. Question 23. Auntie Gina, question 23.
Please let someone read it. I'm tight small.
Okay. Okay, before the person will read, the impairment is only carried on financial asset to amortized cost. Amortized cost, you see that we don't do any fair value measurement. Other comprehensive income, profit or loss, we do fair value. At the end of the year, we look for the fair value of the asset. So any decrease or increase is already taken into consideration. But amortized cost, we don't fair value. So if the value is reducing, we don't know. If the value is increasing, we don't know. So the impairment is always done or is done on asset carried at amortized cost. Okay, let's take note of that. Question 23. Okay.
On 5 January 20X1, NAPA purchased a bond for $1 $1 million, which is measured at amortized cost. Interest of 10% is payable in arrears. Repayment is due on 31st December 20X3. The effective rate of interest is 10%. On 31st December 20X1, NAPA received interest of $100,000. It estimated that the probability of default on the bond within the next 12 months would be 0.5%. If default occurs within the next 12 months, then NAPA estimated that no further interest will be received and that only 50% of the capital will be repaid on 31st December 20X3. The asset credit risk at 31st December 20X1 is low. Required. Discuss the accounting treatment of the financial assets at 31st December 20X1.
Okay. Okay. So what is the value of the asset? Is 1 million, isn't it? Okay. So you can see that the effective interest rate is the same as the nominal rate because there is no discount and there is no transaction cost. If that happens, the nominal interest will always be the same as the effective interest rate. Okay. On 31 December 2X1, NAPA received interest of what? 100,000. Calculate 10% on 1 million and see what you are going to get.
That's 100,000.
Okay. It is estimated that the probability of default on the bond within the next 12 months will be what? 0.5%. If default occurs within the next 12 months, then NAPA estimated that no further interest will be received and that only 50% of the capital will be repaid on what? Will be repaid on 31 December 2X3. The asset credit risk at 31 December 2X1 is low. That they're just telling you that the risk is not significant. So we use 12 months expected losses. But the question is, at the end of December 2X1, what would be the value of the bond? What would be the value of the bond if this bond is carried at amortized cost? If the bond is carried at amortized cost, and the effective interest rate is the same as that, the value will still be the same. So the value will be 1 million. Our finance income will be 0.1 million, and our coupon will still be 0.1 million. So at the end of the year, it will still be 1 million. Okay. When are they making the estimate? When are they making the estimate that only 50% of this amount will be received? When?
31st December 20X1.
Okay. How many years are left on the bond? The bond will be redeemed after what? The bond will be redeemed on what? What date was given?
Within the next
No, what is the repayment? When will the
31st December 20X3.
okay, so 31 December 2x1 to 31 December 2x3. How many years is that?
3 years.
Are you sure?
That's 2 years.
That is 2 years. 2x1 is the same as January 2x2. Robert, are you okay? 2x1
Yeah, fine.
December to 2x2 December, that is 1 year. That one will be what? 2 years. So in 2 years' time, we are going to receive only 50% of what? The nominal what? Value. And that 50% is the same as what? 500,000. Am I correct?
Yes.
Okay. And we are not going to receive any further interest again. That is telling you that we are going to receive lower than what we should receive. So the asset has impaired. But this 500,000 will be received in what? 2 years' time. So what do we do? What do we do? Yeah. So what we do is that we find the present value of the amount that we are going to receive in the 2 years' time, which is 500,000. So we have the 500,000 divided by the original effective interest rate. The original effective interest rate, which is 10%. So this will give us 500,000 over 1.1 exponent 2. Someone can also do this like this. PV is equal to 1.1 exponent 2 times 500,000. They're all the same thing. What are we getting?
413.
4,
413.
413,
223.
22,
3.
223. Okay. So this is the amount that we are going to receive, isn't it?
Yeah.
Okay. Now what is the today's value of this? What is the today's value of what is the carrying value of the asset? It's 1 million. Okay. So they are saying that we are going to receive half of this in 2 years' time. So the present value of this amount today is 413,223. And the carrying value of the asset is this. So what is the difference? What will be the loss that we are going to suffer? What is the expected loss that we are expecting? That will be 1 million minus 1 million minus 1, 413,223. What are we getting? What are we getting?
586.
So the expected loss is 58 what?
6.
586
777.
777. Okay, that is the expected loss. Okay, they say that it is estimated that probability of default on the bond within the next 12 months will be what? 0.05. So this is the expected loss. But this expected loss, it is only 0.05% that is likely to happen. So what is the 0.5% of this? We find the 0.5% of this to make the provision for the 12 months. So this is the expected loss, but only 0.5 of this is likely to happen. So we find percentage of that. So that will be 0.05. 0.0005 times 586,777. What are you getting?
Three.
Okay, 29.
2934. I'm running to the nearest.
Okay, 2934. So for this year, our provision for the loss is 2934. So this will be charged to profit or loss. Then if you come to statement of profit or loss, we are going to have a finance income of the 10,000, which is 100,000, 10%. Then we have provision for loss of 2934. If you go to your statement of financial position, you are going to show the financial assets at a full amount because the impairment has not happened. So 1 million. But if you count to your liability, this is an asset. You count provision on the liability. The provision you show your 2934. Okay. If it is the first time that you are making the provision for loss, which is 12 months, we treat the provision as what? As a contra liability. But if subsequently the risks associated with the asset has increased significantly, then we use lifetime what? Expected losses. We use lifetime expected losses. The lifetime expected losses, the value will now be subtracted from the what? The gross value of the asset. Let's take the question 24. Let's solve two questions on this. Let's solve the question 24. Question 24. On 1st February,
On 1st February 20x6, Eve made a 4-year loan of $10,000 to FEN. The coupon rate on the loan is 6%, the same as the effective rate of interest. Interest is received at the end of the year. On 1st February 20x9, FEN tells Eve that it is in significant financial difficulties. At this time, the current market interest rate is 8%. Eve estimates that it will receive no more interest from FEN. It also estimates that only $6,000 of the capital will be repaid on the redemption date. Eve has already recognized a loss allowance of $1,000 in respect of its loan to FEN required. How should this be accounted for?
okay. So the question is saying that the risks associated with the asset is not significant, isn't it?
Yes.
Okay, if it is significant, then we use a lifetime what? Expected losses. And you can see that the company has already made allowance of what? 1,000 in respect of what? The loan. That was a 12 months losses. Okay. They are saying that they are not going to receive any more interest again, isn't it? But they are only going to receive a 6,000 at the date of what? Redemption. The question now is, from the date that the loan was given to the company to the date that we are doing this, how many years is that? How many years is that?
That's 3 years.
That will be 3 years.
Yes.
2x6 to 2x7 is 1 year. 2x7 to 2x8 is 1 year. And that is 3 years. So the question now is, how many years is for the loan? The loan will take how many years?
4-year loan.
Okay. So it means that we have how many years left?
1 year.
We have 1 year left. So what we do is that we have the question, that will be question 24. Then what we do now is that we look for the carrying value, the gross carrying value of that. The gross carrying value of that is the same as the one given to you, which is a 10,000. So the gross carrying value is a 10,000. At the date that we are doing this, because the coupon rate is the same as the nominal rate. So that will be the same as the income, and that will still be the same as what? The coupon. So the two cancel out and you still have the nominal value. But the question now is, we have done this for 3 years. And the question is now saying that in the last year, we are not going to receive any interest. But at the end of the 4 years, we are going to receive only what, 6,000 as a redemption amount. But this 6,000 will be received in a year time because we are at the end of the 3rd year and the loan is for 4 years. So this amount will be received in what? In a year time. So what will be the today's value of that? Because we want to do that thing today. So we find the present value of that particular amount. So the present value of the redemption amount will be the present value. We use the original interest rate, original effective interest rate, not the 8%. We use the original interest rate. We use the original interest rate. We use the original interest rate. So that will be 6,000 divided by 1.06. What are we getting? We have only 1 year left.
That'll be 5,660.38.
Okay, let's make it 5660. Okay, so the question now is, this is the fair value now, and this is the carrying value. What is the difference? What will be the lifetime expected losses on this? What will be the loss on this? That will be 5660 minus 10,000. You can see that this one, it didn't give you the probability of default. They didn't give you the probability of default. So any figure that you are going to get over there is the value that you are going to receive. So the difference between the two will be the loss. So what will be the loss? What will be the impairment loss?
4,340.
4,340. This is not the total loss, but we have already made a provision of what?
1,000.
So the figure that will go to profit or loss will now be the 4340 minus 1,000. And that will give you 3340. The total loss is this, but you have already made a provision of 1,000 already. So the difference will go to profit or loss. But what we are going to do subsequently is that the loan note, the financial asset, will now be carried at its net realizable value or the recoverable amount. So the recoverable amount will now be the 5650. 5650. So in the subsequent year, which is the subsequent year, which is the third, which is the final year, what we'll do is that our interest or our finance income will now be calculated on this amount. So the finance income will now be 0.06 times 5660. What are we getting? Okay, 339. Add it to that one and see whether you are going to get a 6,000. You'll see that it will be, because we have approximated this one.
5999.8.
Yeah, so it should have been 6,000. So in the last year, you calculate your interest on this so that if you add the two, you receive your what? Your 6,000. Because they say you are not going to receive any interest again. You will receive 6,000 at the end of the life of the assets. So you just present value that. Then what is the loss? The loss, you subtract the initial loss that you have made. The difference will go to profit or loss. Then you will now carry your what? Your asset as the what? As the recoverable amount. Because the risk has what? Increased significantly. That is all that we do. But the question 25 Oh, let me see. Let's look at question 25. Let me explain it. Okay. Question 25. Let's look at it and I will explain it.
Okay, so question 25.
Okay.
On 31st December 2022, Hamza Limited purchased 10 million Ghana cedis 5% bonds in James Limited at par value. The bonds are repayable on 31st December 2025, and the effective rate of interest is 8%. Hamza Limited's business model is to collect the contractual cash flows over the life of the asset. At 31st December 2022, the bonds were considered to be low risk, and as a result, the 12-month expected credit losses are expected to be 10,000 Ghana cedis. On 31st December 2023, James Limited paid the coupon interest. However, at that date, the risks associated with the bonds were deemed to have increased significantly. The present value of the cash shortfall for the year ended 31st December 2024 were estimated to be 462,963, and the probability of default is 3%. On 31st December 2023, it is also anticipated that no further coupon payments would be received during the year ended 31st December 2025, and only a portion of the nominal value of the bonds would be repaid. The present value of the bonds was assessed to be 6,858,710 Ghana cedis, with a 5% likelihood of default in the year ended 31st December 2025 required. With reference to IFRS, calculate and discuss the financial reporting treatment of the bonds in the financial statements of Hamza Limited as of 31st December 2022 and for the year ended 31st December 2023, including any impairment losses.
Okay. So the initial value of the bond is 10 million.
Yes.
Okay. The initial value is 10 million. Okay. And this will be redeemed on what? December 2x5. So that will be 3 years. We are buying it December 2022 and it will be redeemed on December 2025. That is 3 years. So you can see that the effective interest rate is 8% and the coupon rate is what? 5%.
5%.
Okay. The bonds are repayable on 31 December. Okay, I've looked at that one already. Hamza's business model is to collect the contractual cash flow over the life of the asset. They are just telling you that they are willing to keep it up to the date of maturity. So it will be classified through amortized cost. That's what they are saying. Okay. At December 2022, the bonds are considered to be low risk. If it is low risk, it is 12 months expected losses. So the 12-month expected credit losses were expected to be what? 10,000. So at that date, what they will do is that the company, at the beginning of the year, which is December 2022, what the company will do is that the company will calculate they will take it through the amortized cost. They will take the investment through amortized cost, which they are going to have the year one. Then they will have the balance lower down. They will have their interest. Then they will have their coupon. Then they have their balance carried down. So what we'll do is that, yeah, okay, at that date, we are buying the thing at the same date, isn't it?
Yes.
We had, okay, so there will not be any interest for this year. There will not be any interest for 2092. Okay, there will not be any interest for 2092. So the only thing is, at that 2092, what will happen is over there is that the asset will be recognized. The company will recognize a financial asset of 10 million, that they will recognize a provision or loss provision of what? 10,000, which will go to profit or loss and also be kept as a separate item in the statement of financial position. That will be shown as a liability. We don't subtract it from the 10 million because it's just something that is for 12 months. It's a provision. So we keep it as a separate item. If it is a 12 months, we keep it as a separate item. But if the risk has increased significantly, that is why we subtract the losses off from the carrying value. Let's now come here. Okay. So the first year, the company will create a provision or loss provision of 10,000, but the asset will be carried at its initial value. So the provision will be shown as a separate item in the statement of financial position. On 31 December, James Limited paid the coupon interest, and however, at that date, the risks associated with the bonds were deemed to have increased what significantly. So we are moving from 12 months now to what lifetime expected what losses. So through this year, 2023, what will happen is that the company will have the financial assets. The company will have the financial assets at 10 million. Then their finance income. Then their finance income or financial income. So finance income will be 8% on the 10 million. 8% on the 10 million. Would that give us 0.8?
Yes, 0.8.
Okay. That will give us 0.8 million. Then they will come to their coupon. What will be the coupon? The coupon is 5%. Would that give us 0.5?
Right.
So what are you going to have? We are going to have 10.3 million. This will be the value at the end of what? 2023. But what are they saying here? They are saying that the risks associated with this bond were deemed to have increased significantly. So at this date, we have to make a petition for a lifetime what? Expected losses. Let's take the question. The present value of the cash shortfall for the year ended 31 December 2x4 were estimated to be 462,963, and the probability of default is what? 3%. So let's find the loss, probability of the loss over the probability of the default. That is the expected loss, but the one that is going to happen is only 3%. So let's find a 3% on that. That will give us 462,963. That is for 2x to 2024. Okay. On 31 December, it is also anticipated that no further coupon payment will be received during the year ended December 2005, and only a portion of the nominal value of the bond will be repaid. The present value of the bonds are said to be this and this. So we are estimating for this one also. We have estimated one for 2024, and we are estimating this for what 2025 to which 5% likelihood of default. So this is for only 2024. We do 2025 too. We add the two and now bring it to 2023. So we look at the loss for each of them. So this will be 0.05 times 68,6858710. How much are we getting? This one give us how much? And this one give us how much?
First one is 13889.
138.
889.
Okay.
8.
The second one is what?
34. 2936.
3439.
3429.
Okay. 3429.
36.
6858. 710. So 3, 4,
29.
3.
36.
Okay. 2936.
Yes.
Okay, let's add a 2.
35. 25.
35.
6825.
6825. Okay, this is the total lifetime expected losses. But the question is, we have already made a provision of what? We have already made a provision of what? 10,000, isn't it?
10,000, yeah.
Okay, so let's take the 10,000 from that. So our provision that will go to profit or loss now, our provision that will go to profit or loss now will be the new provision, which is 356825 minus the 10,000. And that will give us what? 346825. This will be the one that will go to profit or loss. This is the increment. Okay, but this will be our total provision now. But since this has increased significantly, our financial asset will now be shown as the fair value, which is 10.3, which is 10,300,000. Then we subtract the losses from it. The losses will be 356845. What are you getting?
Nine nine 43175.
9943
175.
175. So this is the amount that will be shown in the statement of what? Financial position for 2023. So subsequently, the finance income will be calculated on this amount. But the coupon will still be calculated on the initial amount. But the finance income will be calculated on this amount. So that is all about this particular question. So this is all about financial instruments. Tomorrow, I'll release a note so that those who are doing financial reporting here, I have a group that have been doing a special class. Those who have written the financial reporting before, I have a group that we do the special revision class. So don't worry. So if you are doing financial reporting here, I will share the links with you. If you are doing corporate reporting too, I have people that have been teaching special, those who have written the corporate reporting before. We do special class. So I'll still share the link with you tomorrow. Tomorrow we continue with disposal, but we are going to do a standard which will be intangibles, IS38. We are going to do it maybe tomorrow in the morning or maybe one that way. I don't know. But we do it before we do the disposal in the evening. But Monday, we are going to do earnings per share. Earnings per share. Maybe the Saturday that will follow, we do leases. Then maybe some petty standards that we just finished. So don't worry. I will share the link with you for tomorrow, and I will share a note on IS38 intangibles. All right. So this is all about financial instruments. It is coming for corporate reporting and financial reporting. All right. Any question?